Today we're here to talk about mortgages, but obviously our goal and objective is to make them entertaining as well. Today we will focus on covering what is happening out there whenever it comes to mortgages, what we need to know, whether we're about to take on a mortgage, whether we will do it at some stage, even if it's not imminent, or we already have one. I'm joined today by expert mortgage broker to dentists, Mrs. Sarah Grace. We're going to be covering all of those things and more so that you can ensure you are paying the least that you possibly can to get that dream house.
Hi,
Hi
James.
Sarah, how's it going? Good to see you
Yeah,
again.
good. Thank you. Good. Yes. So, what's happening with rates? Well, we're in a large year for remortgaging. A lot of people coming off 2-year deals and also 5-year deals. So, if you're coming off a 2-year deal, the rates where they're sitting at the moment are probably not that dissimilar to what you were on 2 years ago. They might be a little bit lower. They may be a little bit higher. It depends on what sort of deal you had 2 years ago, but they're about the same. The bad news is for the people, of which I am one, coming off a 5-year deal of probably well, I've even got some clients with a 0.99 deal that they're coming off. But yeah, your rate you're coming off is probably starting with a 1, and you're probably looking at going to a rate starting with a 4.
Oh, ouch.
Now, yeah, there are some trackers. So this is probably the big dilemma at the moment. Tracker rates, that tracks the Bank of England base rate. Obviously, since all of the conflict in the Middle East, we haven't seen the Bank of England base rate go up, yet fixed rates have. And fixed rates probably at the moment are about 1% higher than what they were at the end of February. So at the end of February, we could get a 2-year fixed rate, for example, at around 3.64. Today, that is 1% more. And that's with HSBC. 4.64 is the rate with HSBC today on a 2-year deal. So um, tracker rates are actually looking like a good option. However, it's not for the faint-hearted, because if Bank of England base rate goes up by 1%, well, then you'll be paying 1% more. Every time the Bank of England increases their rates, you will pay that increase. Or likewise, if they decrease, you will pay that decrease by typically 1/4% they increase or decrease them by. Um, but when I was doing some research yesterday, I could get a 3.96 tracker, so it's 0.21 over Bank of England base rate. So that's actually looking quite competitive, because rates would have to go up by 0.75% before it's matching that 2-year fixed rate. Um, so so yeah, the tracker rates are an option. And if you're not adverse to a bit of risk, that might be a good thing. The other advantage of a tracker at the moment is most lenders, but just be careful of that when you are looking or getting your broker to, is most of them don't have early redemption charges. So if rates do start going up and you're getting a bit nervous and you want to lock in a fixed rate, you can do without any early repayment charges. But there are some lenders that have tracker rates with an early repayment charge, so you would incur that fee. So I would always suggest, if you're doing a tracker, make sure you have no early repayment charges. So that's it on the sort of rates. Other things that are going on, we could have some FDs, people finishing their foundation year or years, going into associate positions, sorting those out from August, September time. Um, you need to have 2 years accounts to be able to get a mortgage. because obviously you'll be going self-employed. No, you don't. We can work off 3 months, 3 months pay schedules, invoices, whatever you want to call them, from your principal, or principals if you work at multiple practices. Um, we can work off your 3 months earnings. So obviously, the first few months of going associate, you're perhaps earning a little bit less because you're building up your client list, speed, and everything. But if you're doing, let's say, 5K a month for the first few months, well, that lenders will use that as 60K income. So um, they can base their lending decision on an income of 60K. So you can get a mortgage with just 3 months of pay schedules for associates. Um, yeah, so that they're probably the main two things that are coming up over the next few months. What do I think is going to happen to interest rates? That's a tough one because it I think a lot of it depends on what's going to happen in the Middle East. If they do a deal and that all settles and inflation pressure is low, well, I think rates will come back down to sort of, perhaps this is fixed rates where we were in February, so perhaps 1% lower than what they are today. But we've got inflation and Bank of England meetings next week. So if inflation stays lower, like it's currently sat at around the sort of 3% mark, if it doesn't go up any more than that, I think there'll be a hold on Bank of England base rate. If it's starting to spike, well, then Bank of England base rate's likely to go up, and news like that then does affect the fixed rates, which is the reason why we've seen fixed rates increasing, even though Bank of England base rate hasn't, because that is going on the money markets, and it's the lenders basically are swapping their variable rate because they want to hedge against the risk of loads of clients being on a fixed rate. So lenders, how they calculate their fixed rates is they go to the money markets, and that's called swap rates. They're swapping their variable rate for a fixed rate for you to take out a fixed rate mortgage, because they don't want to take the risk of giving you a fixed rate and Bank of England base rate going up, and they then can't afford. That's when you have runs on banks and they can't afford. You're paying a really low rate, and yet they're borrowing at a much higher rate. They can't afford to do that. So they go to the money markets and they swapping their variable rate for a fixed rate, and that reduces their risks massively. So swap rates have gone up, and they have actually gone up last night because of the Israel Iran firing yesterday at each other. So things like that have a massive impact on the market. So it just depends on what happens there. But as long as that ceasefire can hold off and they do a deal and the straits keep open, I think, and before winter, so inflation's not affected too much, and fuel, I think we can see hopefully a bank base rate of somewhere between 3 and 3.5%. But if inflation does start going out of control, I think we're more likely to see a Bank of England base rate of between 4 and 4.5%. So it's very hard to predict. What should you do? Should you have a fixed rate, a tracker rate? Again, that's down to your appetite for risk. 2-year fixed rate, that might just see you through the turmoil of the next 2 years, and in 2 years' time, hopefully we should see things settle and back to a new normal. Um, but if we look at the last 5 years, we've had COVID, we've had Ukraine, and now we've had this Middle East conflict. There are always things going on. So if you want to take out all of those risks, well, really, typically the longest fixed rate you're going to get with the majority of lenders is a 5 year deal. And I would say 5 year, and then you don't have to worry about it. Um, so yeah, those are your options.
Good to know. Good to know. Well, do you know what, Sarah? Here's something that I just wanted to add on top of all the things that we said today, because obviously this has been a really good summary of what's going on in the world and how it relates to mortgages, and more specifically how it relates to the mortgages of dentists. Tell me about interest only mortgages, because you know what I always find interesting, no pun intended, about interest only mortgages is that the when I talk to mortgage brokers, a lot of mortgage brokers have interest only mortgages, which kind of tells you that, how can I say this? There's a little bit of a clue there that, well, they might offer some advantages.
Yes, so in interest only mortgages, you need to have need to have a minimum equity of 15%, but it depends on which lenders. The majority, it's 25%. And it depends on what you mean by interest only. Do you mean interest only and you plan to downsize, i.e., sell that property and downsize to a smaller property? Well, then some lenders will only do 50% of the value interest only. Uh, the rest needs to be capital repayment, or you need to have 300k equity. So yes, interest only is an option. Typically not an option for first time buyers, but again, there are some lenders that will do that for first time buyers. Um, but yeah, it's a great way. My mortgage, my own personal mortgage, is interest only, but that's because I wanted to have a bigger house. I don't have any children, so I didn't want to be a mortgage slave and then be paying a mortgage for a large property, and then when you come to retire and downsize, you've got a load of equity, and then you've got to get rid of it and spend it because you don't want the tax man to take it when you die as well. So that was the choice that I made. Is that I want to, it's cheaper than rent, um, and I've got enough equity in it to downsize to something very comfortable when I want to retire. And so that's how I've worked my interest only. It's not for everybody, but you know, dentists tend to be quite entrepreneurial, quite sort of higher risk takers, and so therefore it might be suitable to them.
Sure, or there's even the possibility that if you know what you're doing whenever it comes to the investing side of things, that you could take the money that you would have been repaying into the mortgage,
Yeah.
put it in your ISA, grow it, uh, hopefully make a little bit of a profit in terms of you having more cash than what you would have had if you would have repaid the mortgage, and then take the money out tax free whenever the
Yes.
principal is repayable, and as I say, have enough to pay off the house and also have a little tidy little profit in there too. So
Yes.
there is that possibility. Not
There's
saying
also
that's
there's also tax-free lump sums. Some, quite a few clients have nice NHS pension schemes, which
sure.
they'll have their tax-free lump sum from their NHS pension scheme that can be used as a repayment vehicle for the interest only. And yeah, you can use an ISA as a repayment vehicle. But pensions and ISAs are good examples because they're quite tax efficient going into them, aren't they?
Well, there you go. But it's all based on providing that stays the same, that the rules around those for the next X number of years.
Yes.
There is a little bit of a gamble there, of course,
Yeah.
but you can get a lot of house. Um, you can get a lot of house for and be in a position where you don't have to repay that much every month. But it's just
Yeah.
depends on whether or not you're comfortable with that. Can you walk me through that thing that you were saying just a second ago? I know I get that what you were saying about how some lenders will ask for typically a 25% deposit and some will
Hmm.
ask for 15% deposit if you're going to go down the interest only route. But what was that thing that you talked about immediately afterwards, which was there seems to be some rules around the equity
So
side of things?
yes, if your plan, if because lenders need to know how their money is going to be repaid
Right.
at the end of the term. So if you do what they call pure interest only, i.e., you haven't got a a repayment vehicle like a pension or an ISA,
Yeah.
you can say, right, my repayment vehicle is sale of of the mortgaged property, the home that you're going to give a mortgage on.
Yeah.
Now, there's typically you need, I would say, I think the lowest amount of equity that any one lender that will give, it needs to be 150k in equity or 25% of the value. So if you're buying at 1 million or your property's worth 1 million, it's going to be the 25% equity that you need to have. Um,
Do you mean in terms of the if I've understood this correctly, do you mean the deposit?
deposit
Right.
or equity, yeah. So 250k, and then you can have a mortgage of 750.
Yes, fine.
Yes,
Right.
but if some lenders say that if sale of the mortgage property is the repayment vehicle, they'll only give 50% of the value.
Oh, really?
But you can still go up to 75%, 85%. The remainder has to be done on a capital repayment basis.
Yeah, so you can have like a blended solution,
Part and
right?
part and part. Yeah. Yeah.
Ah, okay.
Yeah.
Interesting, because I have to admit, it's something that has always appealed to me. Given that I would, well, hopefully think that I could use the ISA to make up the difference or the pension. Obviously, no one can predict the future, but I feel
Yeah.
pretty comfortable with that.
Yes.
And then have a little bit of a tidy profit left over. Because remember, if you know what you're doing in your ISA, the stock market. I mean, I'm just quoting averages here. I'm not saying that this is going to indicate future performance for everybody, but the stock market is said to return 10% per year, whereas
Yes.
obviously the house is 6% a year, and your debt might be appreciating at a rate of 3% a year. Okay, so if you take the money that you would have used to repay your debt, knock off inflation, you're making basically 7% return net. Okay, which is much better than what well, by the time you've paid off the principal, you're going to have more in there than you would have done otherwise, basically, versus
Yeah.
just paying the debt off continuously. And I get that that's a little abstract, but we should probably do some worked examples on that one at some stage. But
Yeah.
suffice to say you're going to make a little bit of profit if you borrow £1 million. Okay, you then, let's say you're repaying the million. Here's a very crude example. Okay, you borrow £1 million, you're repaying £1 million. Right, at the end you're all square. Okay, but instead of repaying the £1 million, if you then take it and invest it for 20 years, okay, I haven't done the math on this, but you might have like 1.5 million. You can then repay the million and have 500k
Yes.
profit. Now it doesn't work
Yes.
exactly like that. I'm just doing it for simplicity of understanding, but that's the principle behind it.
Yes. Yes. And that's the thing. Don't also forget, because like, yes, okay, in today's market, let's say interest rates were 5%, and you're getting a 10% return in your example. Well, you are up. Um, Obviously, markets can change, and you can go down as well as up. In that in But also the other thing factor is if your investment is staying ahead of inflation, that £1 million mortgage is being eroded by inflation as well. So although it's still sat at £1 million, over a 25-year period, £1 million 25 years ago was a lot more, probably 2.5 million in today's terms.
Yeah, we'd have
So
to do the math, right? But significantly
yeah,
less. And we're talking because it's such long time periods. You're actually when you're a borrower, inflation works for you, not against you.
yes,
Um,
yes,
Obviously that also erodes your final pot as well because the 1.5 million in real terms is maybe I don't know. Well, it's much less than what it would have been if you would have had 1.5 million 20 years ago. But there's
yes,
still a differential there that means that you're in profit because that's the principle of how investing works. It outpaces inflation. Yeah.
yes,
Um,
yeah,
or at least whenever you use the whole ETF strategy, which people commonly do. But yeah, anyway, not to digress. I just wanted to touch on that. I don't think we've ever talked about that in the podcast, Sarah, and it's such useful stuff to know. Maybe if
yeah,
we have, it was a long time ago, and it's worth saying again because a lot of
yeah,
people on these podcasts who listen to these are educated whenever it comes to the finance and what have you. So it's good to know these things are out there because um, I always remember this one of my friends who insisted that I read a book on finance maybe like 10 years ago, which kind of got me into this whole rabbit hole. He was one of the exact same friends that like a year ago he was like, James, have you heard of these things called interest only mortgages, right? And he was absolutely, how can I say this? He was just besotted with the idea that what he could do with that. And I was like, you
yeah,
mean you didn't know that? I remember you showed me this book ages ago when you. It's kind of things have flipped on their head here because I thought everybody knew about this. So that was actually kind of what inspired me to mention that today in the podcast because I don't think people know this sort of stuff. Sarah, have we done a really good job of rounding up today's mortgage market today on the podcast?
yeah, yeah. I think we have. Obviously, I'm biased.
It's okay to blow your own trumpet every once in a while. Sarah, if anybody wants to reach out to you off the back of the podcast, how can they do that?
Yep, just give us a call 0203 633 888 or go to our website sarah-grace.co.uk and you can contact us through that. And we've got lots of blog articles, and we're having a bit of a refresh on our website. So if you think it's a bit sort of out of date, well, don't watch this space. It is in the process of being changed, but there's a lot of useful, frequently asked questions, that type of thing on there. But yeah, just reach out to us, get in touch. We're always happy to help, happy to have complimentary chats with people. I've also got another colleague, Jordan, who she can help people. She typically works with a lot of first time buyers. Um, and so, yeah, great.